Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me for this segment, we have Michael Reynolds, Vice President of Investment Strategy at Glenmede, to discuss the market's reaction to the inflation data this week and if it will have an impact on the Fed's interest rate strategy next week's FOMC meeting. Michael, it's great to see you as always. Welcome back to Trade Talks.
Happy to be here, Jill.
You got it. And how did you interpret the market's reaction to the inflation data this week? And do you think it's going to have an impact or any shift to the Fed's strategy at the FOMC meeting next week?
Sure. So I think what matters most for investors around these CPI releases is how it ultimately translates to what the Fed's reaction function to it is going to be. So going into Wednesday, it really wasn't a question whether or not CPI would accelerate. There were some pretty broad-based expectations that it would, based on energy-driven commodity rally that we saw through the summer. The big question was just how much that would come through and whether or not it might actually bleed into some of the other components of the CPI basket. The release itself, wasn't really outside of the realm of expectations and really solidified this thought process for investors that the Fed's probably going to take a pause on its rate hike campaign next week. There was perhaps some lingering uncertainty that they might try to raise rates after a truly blowout CPI, but we just didn't get that. And the market has seemed to embrace that to some extent.
Mm-hmm. Do you think a soft landing is the base case then?
So we continue to take a look at the lay of the land and think through all the signals that some of the best leading indicators are telling us. And it's really hard to see a scenario where the U.S. avoids recession. It's the yield curve, tightening lending standards, the Fed funds rate, many others that are really giving us a classic signal that recession is on the horizon. I know that some are getting impatient, but the economy just really doesn't move at the speed we've really become accustomed to in this social media digital era. But we're well within the bounds of historical timelines for recession. And really that's our base case at this point in time.
The tailwind of excess savings has propped up consumer spending for some time. Do you think the strength of the consumer is at risk with those savings winding down and student loan payments resuming October 1st? It's definitely a much more expensive environment for the consumer.
Yeah, we do think the consumer is at some pretty heavy risk here heading into the back portion of this year. Just this morning, we saw some more signs of incremental weakness on the U.S. consumer out of the University of Michigan survey. But more broadly than that, it's that arsenal of savings that consumers built up over the pandemic period that's on track to run out by the end of this quarter. This is especially true for those that sit on the lower end of the income stack, which is important because they tend to be have one of the highest marginal propensities to spend that money. Student loan payments resuming are really a decent part of that narrative, and in some cases may even have accelerated that trend. We've heard anecdotally of some who've used a big chunk of their savings just to pay off the loans as they started to come due again. Those are dollars that can't be flexed into big purchases if something comes up and the time is right. The consumer overall is really an engine of growth in our economy, and it's at real risk of faltering later this year into early next.
And Michael, if a recession were to materialize, how would it impact equities, fixed income, and even cash?
Sure. So I would say, starting with equities, we're pretty concerned about what equity returns could look like as we head into this upcoming recession. We are still seeing 75th percentile valuations on U.S. large caps. If we look back at the history on that, we've never seen equities maintain premium valuations up to and through recession. That says nothing of the downside if equities actually start to trade at a discount amid period of uncertainty around that recession. So we're currently recommending to our clients a pretty sizable underweight there. If we turn to the rate side of things, history sort of tells us that before recessions is really when you want to start loading up on duration in your portfolio. Investors, from our perspective, should be opportunistically looking to extend that duration when we get these periods of rising rates, just like we saw a few months ago. Cash is actually sort of interesting, though. As investors, we've kind of become conditioned over the past two cycles that cash offers really no upside in recessions because the Fed slashes rates to zero and there's really no yield reason to carry it. It could be a little bit different this time, as the Fed's going to have to keep rates reasonably high if it's going to hope to fend off a second wave of inflation like we saw in the 1970s.
All right, Michael, we appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.